Hi, Kelly. For sure. And one thing that Steve left out is the Fed is also going to be initiating a quantitative tightening going from 0 to 95 billion in 3 months versus the 0 to 50 billion over 12 months in the previous QT. So it is a double-barreled form of tightening that is going to impact not just the economy, but also markets. But to your point on China, yes, it mucks up their entire analysis. But on the other side, it also further strains the supply chains, which then keeps inflation elevated, which then forces them to continue to tighten.
True.
So it's a no-win situation, and it's just a question of how much pain will they tolerate as they work their way through this tightening cycle.
You are very good at seeing kind of the global linkages with the financial system, and I'm thinking specifically of the U.S. dollar here. It's on a historic move. What happens next?
Well, it is a great question because the dollar has mostly been strong against the euro, the yen, and the pound, and only recently against the yuan. But the commodity currencies up until the last couple of days have traded great against the dollar. Brazilian real, Mexican peso, South African rand, even the Australian and Canadian dollar being commodity currencies. So it does, in the aggregate and on paper, squeeze global liquidity. But I do want to differentiate because it's very easy to see, oh, the dollar's up or the dollar's down. The dollar's really only been mostly strong against some currencies and not so much against others.
Great point. Does the fact that those currencies represent most of global GDP have any impact? Meaning, so if we have a situation where the euro, I don't know where you think it's going from here, but we're so low that, I mean, do these moves keep going or not? The Japanese yen, we talked about this, that their policy is basically to try to keep pushing it lower in order to achieve some of their macro goals. The Chinese currency collapsing because of everything that's going on. So can this move continue after we've already gotten to such what seem like kind of extreme levels?
To me, the currency cross rate that everyone has to be watching is the dollar yen because of the pronounced impact of a potential change in policy. The Bank of Japan and the Ministry of Finance have two choices. They continue with yield curve control, and the yen continues to weaken, and inflation becomes a problem there, particularly on the energy side, since they import most of those needs, or they widen the yield curve control band to maybe 50 basis points or more, and then that itself creates major reverberations through the world's bond markets.
Right.
It is a very difficult question that they're going to have to answer, but they're reaching a point where they're going to have to make a decision. And that's the cross rate that I wake up every day wondering where it's trading. And the yen's about at a 20-year low against the dollar.
And yet, and I'm just got to squeeze this in and then we have to go, but just this morning, Nikkei is reporting that Japanese policymakers are considering inflation relief measures like gasoline subsidies. Why don't they just abandon yield curve control? Wouldn't that accomplish their goals without, tempting the markets?
Well, that and also abandon this 2% inflation rate. Because be careful of what they wish for. They're already showing that, yeah, if we got to 2% inflation, we have a problem. So it gets into why are we raising the cost of living on everybody if we're just going to shove them money to handle that rising cost of living.
Right. No, this has been the Peter Boockvar line for like 20 years. So I appreciate that we're getting a real world example of the consequences. Peter, we will leave it there for now. Appreciate your time. Thank you, sir.
Shepard Smith here. Thanks for watching CNBC on YouTube.